Hello, unseen economy. Here, if this war does not stop, silver could hit $150. This is not hype. This is the real warning that almost nobody is giving you right now. Right now, as you watch this, the United States and Iran are in the most dangerous standoff since the 1979 hostage crisis. The ceasefire that was supposed to bring peace has been exposed as a temporary pause at best and a complete fiction at worst. Iran has already said the extension means nothing. The naval blockade of the Strait of Hormuz continues. 20 million barrels per day of global oil shipments remain restricted. And the world's largest industrial silver consumer is about to discover that its supply chains are far more fragile than anyone on Wall Street wants to admit. Last night, we saw exactly what happens when the paper market tries to suppress the truth. Silver flash crashed to $75.65 at 2:47 a.m. Eastern Time while most retail traders were sleeping. It recovered to $78.94 within 4 hours after Trump posted a ceasefire extension on Truth Social. But here is what the institutions do not want you to understand. The physical market never panicked. Shanghai fixed silver at $90.89 this morning, a $12.24 premium over the COMEX paper price. That 20.3% gap is not noise. It is the market telling you that real metal is already worth far more than the digital claims being traded in New York. If the war escalates from here, that gap is going to explode, and silver at $150 becomes not just possible, but the logical outcome of a global supply shock meeting a monetary panic. Welcome to the channel that actually tracks the physical market, instead of repeating whatever headline the institutions want you to believe. If you are new here, subscribe right now and turn on notifications. Because the next 7 to 14 days are going to separate those who understood the real warning from those who got caught in the next engineered smash. And drop your city and country in the comments. I want to know where the serious stackers and analysts are watching from. This is not an American story anymore. This is the entire world story. Let me be absolutely clear about what we are facing. The current ceasefire is meaningless. Iran has already rejected it. The United States has made it clear that bombing remains on the table. The Strait of Hormuz, through which 20% of global oil and critical industrial metals logistics flow, remains under effective blockade. This is not de-escalation. This is the calm before the next storm. And silver sits at the exact intersection of every risk that is about to explode. First, the industrial supply shock. Modern warfare is not fought with iron and steel the way it was in 1945. It is fought with electronics, sensors, drones, precision missiles, communication systems, and electric vehicles that all require massive amounts of silver. A single modern fighter jet uses between 1.5 and 2.5 kilograms of silver in its avionics and electrical systems. A single Patriot missile battery contains over 800 grams of silver. The drone fleets that both sides are deploying by the thousands each carry hundreds of grams of silver in their flight control systems, cameras, and communication links. If this conflict widens, the United States and its allies will need to replenish stockpiles at a rate we have not seen since World War II. That means an immediate surge in defense-related silver demand on top of the already record industrial consumption from solar, electric vehicles, and data centers. Mine supply cannot increase fast enough. Recycling cannot fill the gap. The only way to balance the market will be through price, and that price will be measured in triple digits. Second, the monetary panic. Every time geopolitical risk spikes, capital flees paper assets and seeks hard assets that cannot be printed or frozen. We saw this in 1979 when silver went from $6 to $50 in months during the Iranian hostage crisis. We saw it in 2008 when silver doubled in 6 months during the financial collapse. We saw it in 2020 when silver surged 50% in weeks during the COVID panic. But this time, the setup is far more dangerous. The COMEX registered silver inventory sits at just 76.9 million ounces against 241.8 million ounces of May open interest. That is a 3.14 to 1 ratio. If even 15% of contract holders decide they want real metal instead of paper promises, the COMEX will face a delivery crisis unlike anything in modern history. The last time we saw stress this high was January 2026, when 33.45 million ounces left the vaults in a single week. That was 26% of the entire registered pool. We are now staring at the possibility of that happening again, while the world is on the brink of a wider conflict. The institutions know this. That is why they engineered the flash crash to $75.65 last night. They needed to shake out the overleveraged retail longs who bought expecting a war premium. They needed to reduce the number of people willing to stand for delivery in May. They needed to buy themselves a few more days before the physical reality becomes impossible to hide. But here is what they cannot hide. The Shanghai Gold Exchange physical price is already at $90.89. Chinese buyers, who represent the largest industrial and strategic demand in the world, are paying a 20% premium for real allocated metal, while the COMEX pretends silver is still worth $78.94. That gap cannot stay open forever. When it closes, and it will close violently, the price will not stop at $90. It will keep going until the market finds a level that brings enough new supply or destroys enough demand to balance. In a full war scenario, that level is $150. Let me walk you through exactly how we get there. First, the safe haven bid. If the conflict expands beyond the current proxy stage, we will see capital flight out of equities, corporate bonds, and even some government debt into precious metals. Silver, with its dual monetary and industrial identity, captures both flows. Gold may go to $5,000 or $6,000. Silver, with its higher beta and tighter supply, will move faster and farther. A move from $78.94 to $150 represents a 90% gain. That is aggressive, but entirely consistent with what silver has done in previous geopolitical shocks, when measured from the low of the correction. Second, the industrial supply destruction. A wider war in the Middle East does not just disrupt oil. It disrupts the entire logistics chain that moves silver concentrate, refined metal, and finished components from mines in Mexico, Peru, and Poland to refiners in Switzerland, India, and China, and then to manufacturers in Germany, Japan, and the United States. Even a partial closure of the Strait of Hormuz for more than 30 days would create bottlenecks that force manufacturers to pay whatever price is necessary to secure supply. We are already seeing this in the Shanghai Premium. Imagine what happens when the disruption lasts 60 or 90 days. Third, the monetary system stress. The United States is entering this conflict with stagflation confirmed. CPI at 3.3%, GDP growth at 0.5%, real interest rates at 0.2%. The Fed has no confirmed chairman. Kevin Warsh's nomination is blocked. Jerome Powell's term expires in May. The FOMC meets on April 29th and 30th with no clear leadership and no clear policy path. In that environment, any escalation in the Middle East becomes a monetary event as much as a military one. Central banks that have already been buying gold at record levels will accelerate those purchases. Sovereign wealth funds will rotate out of dollar assets. Retail investors in Asia and the Middle East will pile into physical silver as the ultimate portable wealth. The COMEX, with its 13.2% coverage ratio, will be the first domino to fall. This is why $150 is not a fantasy. It is the price that balances a market where physical supply is being destroyed by war, while monetary demand is exploding because the paper system is losing credibility. The institutions tried to suppress this reality last night. They used the ceasefire headline to run stops and liquidate longs. They bought themselves a temporary reprieve. But the underlying math has not changed. The registered inventory is still draining. The Shanghai Premium is still expanding. The war risk is still rising. And every day that the conflict continues without a genuine resolution brings us closer to the moment when the paper price and the physical price can no longer be kept apart. In next phase, I'm going to show you the exact technical levels that will confirm the move to $150 has begun. I will break down the gold-silver ratio setup that makes silver's upside even more extreme than gold's. I will show you the specific industrial demand numbers from defense contractors that nobody is modeling yet. And I will give you the one data point that would make me change my entire outlook from bullish to catastrophic. But before we go there, I want you to understand one thing clearly. The $100 dip we just lived through was not a buying opportunity for the weak. It was a final warning for the strong. The institutions showed you exactly how far they are willing to go to suppress the price one last time. They showed you that the COMEX price is no longer connected to physical reality. They showed you that the only price that matters is the one Chinese buyers are already paying in Shanghai. If the war stops tomorrow, silver may consolidate between $75 and $90 for a few months while the market digests the de-escalation. But if the war continues, or worse, expands, that consolidation will never happen. The next move will be vertical, and $150 will be just the first major target, not the final one. This is the real warning, not the one the mainstream is giving you about geopolitical risk. The real warning is that the paper market is running out of time, out of metal, and out of credibility. And when it breaks, the price will not ask for permission. Subscribe if you want the full breakdown in part 2. Drop your location and your current silver position in the comments. I read every single one. The war is not stopping. The inventory is still draining. The physical premium is still expanding. And silver at $150 is no longer a question of if. It is only a question of when the next escalation removes the last remaining break on the price. The technical structure for silver has never been more aligned with the fundamental risks we just discussed. Right now, silver is trading around $78,894 after recovering from the $75.65 flash crash. On the daily chart, we have a clear falling wedge that broke out 2 weeks ago, followed by a sharp rejection at the $82 resistance level, and then the engineered smash lower. That smash took us back to test the breakout zone and the 50-day moving average in one violent move. The fact that we recovered 329 in under 4 hours tells you the underlying bid is extremely strong. This is not a market that wants to go lower. This is a market that is being held down by paper, selling in thin overnight liquidity. The measured move from the falling wedge projects a minimum target of $98 to $105. That is the technical floor if we simply continue the current uptrend without any major catalyst. But we are not in a normal environment. We are in a geopolitical shock that is about to collide with a COMEX delivery crisis. When those two forces meet, the measured move becomes meaningless because the market will gap higher in ways that technical analysis cannot fully capture. The gold-silver ratio is the most important leading indicator most investors completely ignore. It currently sits at approximately 61 to 1. In every major precious metals bull market of the last 50 years, this ratio has compressed dramatically as silver catches up and then outperforms gold. In 1980, it fell below 20. In 2011, it went under 40. A move back to 50 to 1 would put silver at roughly $96 if gold is at $4,800. A move to 40 to 1 would put silver above $120. And in a full war scenario where monetary panic meets industrial supply destruction, the ratio can compress all the way to 30 to 1 or lower. That is how we reach $150. The ratio is compressing right now even as the paper price wiggles. Gold is holding its ground around $4,700 to $4,800, while silver is showing relative strength on every dip. This is the classic setup we see in the late stages of a bull market when monetary demand starts to overwhelm industrial demand. Except this time, the industrial demand is not slowing down. It is about to explode because of war. Let me give you the specific defense numbers that almost nobody is modeling yet. A single F-35 Lightning II fighter jet contains approximately 1.8 kilograms of silver in its avionics, radar, electronic warfare systems, and flight control computers. The United States currently operates 600 F-35s and has another 1,200 on order or in production. If conflict escalates and the Pentagon accelerates production to replace losses or expand the fleet, that alone represents an additional 2,000 kilograms of silver demand per year just for this one platform. A single Patriot PSC-3 missile contains roughly 850 grams of silver in its guidance system, seeker head, and power distribution. The United States and its allies have already fired hundreds of these missiles in recent months. If the conflict widens, replenishment orders will run into the thousands. That is another 1.5 to 2 tons of silver demand that did not exist 6 months ago. Modern drone swarms are even more silver intensive. A single Bayraktar TB2 or MQ-9 Reaper drone uses between 400 and 600 grams of silver in its sensors, communication links, flight computers, and electric propulsion systems. Both sides in the current conflict are deploying these platforms by the hundreds. If the war expands to include direct attacks on shipping or energy infrastructure, drone usage will increase exponentially. The silver demand from this sector alone could add 50 to 80 tons per year of unexpected consumption. This is not theoretical. This is what happens when modern militaries go to war. They do not just burn oil and ammunition, they burn silver. And unlike oil, silver cannot be produced on demand. The mines that supply it take 10 to 15 years to bring online. There is no strategic silver reserve the way there is a strategic petroleum reserve. When the military-industrial complex starts bidding against solar manufacturers, EV makers, and electronics companies for the same limited ounces, the price discovery process becomes extremely violent. The supply chain vulnerabilities are even more severe than most analysts realize. The majority of the world's silver concentrate comes from mines in Mexico, Peru, and Poland. It is then shipped to refiners in Switzerland, Germany, India, and China. From there, the refined metal moves to component manufacturers in Japan, South Korea, Taiwan, and the United States. A significant portion of that logistics chain either passes through or depends on stability in the Middle East. Even a partial disruption of the Strait of Hormuz for 60 days would create bottlenecks that force manufacturers to pay whatever price is necessary to secure supply. We are already seeing the early stages of this in the Shanghai Premium. Chinese electronics and solar manufacturers are paying $90, more trading $89 for metal that the COMEX claims is worth $78.94. They are not doing this because they are speculating. They are doing this because they need the metal to keep their factories running. If the war escalates and logistics become even more uncertain, those premiums will expand from 20% to 50% or higher in a matter of weeks. This is the phase that separates $100 silver from $150 silver. At $100, we are simply seeing the market catch up to the physical reality that already exists in Shanghai. At $150, we are seeing the market price in a sustained supply shock that lasts for months rather than weeks. That is the difference between a geopolitical event and a full-scale regional war. The gold-silver ratio gives us another way to think about this. Historically, silver has been more volatile than gold in both directions. In bull markets, it outperforms. In bear markets, it underperforms. If we enter a genuine monetary panic combined with industrial supply destruction, silver's beta to gold could easily reach 2.5x to 3x. That means for every $1,000 gold moves higher, silver moves $2,500 to $3,000 higher from current levels. This is how we get to $150, even if gold only reaches $500 to $6,000. The technical levels that will confirm this move has begun are very clear. First, a decisive weekly close above $80.50 with expanding volume. That takes us out of the current consolidation and confirms the falling wedge breakout is still valid. Second, a break above $88. This is the level where the institutions will no longer be able to suppress the price without triggering massive short covering. Above $88, the measured move to $105 becomes the minimum target. Third, a break above $100. This is the psychological level where retail and institutional money that has been sitting on the sidelines finally capitulates and piles in. Above $100, the move to $130 to $150 becomes self-reinforcing as stop losses and short covering accelerate. The one data point that would make me change my entire outlook is if the COMEX registered inventory suddenly increases by more than 15 million ounces in a single month without a corresponding collapse in open interest. That would mean either new supply has entered the system or the exchange has found a way to reclassify metal from eligible to registered at scale. It has not happened in 18 months. Given the structural deficit and the war risk, it is unlikely to happen now, but if it does, I would have to reassess the timeline, not the direction. Everything else, including a temporary de-escalation in the Middle East, is noise. The underlying drivers of higher silver prices are not going away. The COMEX is still running a 13.2% coverage ratio. The industrial demand base is still growing at 8 to 10% per year from solar and EVs alone. And the monetary system is still trapped in stagflation with real interest rates at 0.2%. The war is simply the accelerator. It does not create the bull case. It compresses the timeline. And next, I'm going to show you the precise risks if the war actually does stop, the exact action steps for physical stackers, miners, and paper traders, and the one price level that would make me go from bullish to extremely bullish within 48 hours. I will also give you the final warning about what happens when the COMEX finally runs out of metal and the paper price becomes completely irrelevant. But before we go there, I want you to internalize one truth. The $100 dip we just survived was the last time the institutions could suppress the price with a convenient headline. The next time they try, the physical market will already be too tight to allow it. The Shanghai premium will already be too wide. And the delivery calendar will already be too close. This is the moment the warning becomes reality. Subscribe if you want the complete roadmap in next. Drop your thoughts in the comments right now. Are you positioned for $150 silver? What is your personal target if the war expands? I read every single comment. The technicals are aligned. The fundamentals are screaming. The war is the spark. And $150 is no longer a question of if. It is only a question of how fast the next escalation removes the last break on the price. The war may stop tomorrow, or it may expand next week. Either way, the structural setup for silver at $150 remains intact. The only thing that changes is the timeline. If a genuine de-escalation happens, if Iran and the United States reach a verifiable agreement that includes lifting the Hormuz blockade and restoring normal shipping lanes, silver will likely consolidate between $75,000 and $90 for several months. The immediate war premium will fade, some of the panic buying will reverse, the COMEX will get a temporary reprieve as delivery pressure eases, but the underlying drivers will not disappear. The registered inventory will still be at historic lows, the industrial deficit will still be growing at 8 to 10% per year, the monetary system will still be trapped in stagflation with real rates near zero, and the Shanghai premium will still be telling the truth that the COMEX price is fiction. A pause in the war is not the end of the bull case. It is simply a delay. The next leg higher will come when the market realizes that the structural problems never went away. They were only masked by a temporary ceasefire. If the war expands, if the United States begins direct strikes on Iranian oil infrastructure, or if Iran successfully closes the Strait of Hormuz for more than 30 days, the move to $150 will happen much faster than anyone expects. We will see silver gap higher $8 to $12 in a single session. The COMEX will face delivery requests that exceed available registered metal within weeks. The Shanghai Premium will explode beyond 30% as Chinese buyers scramble for any available supply. And the gold-silver ratio will compress violently as monetary panic overwhelms every other factor. This is the scenario the institutions tried to prevent last night with the flash crash to 75.65. They failed. The physical market absorbed every ounce thrown at it. The Shanghai price kept rising. The gap between paper and reality widened. And the countdown to the May delivery crisis continues with only 7 business days remaining. Now let me give you the precise action steps you need to take in the next 48 hours. If you are a physical stacker, this is your moment. The $100 dip from the recent high was the last clean entry before the next leg. Buy allocated and segregated metal from reputable dealers. Avoid unallocated promises that rely on the same fractional reserve system that is failing in New York. Focus on 1 ounce and 10 ounce coins and bars from sovereign mints. These will carry the highest liquidity premium when the paper market finally breaks. Do not try to time the exact bottom of any further smash. The difference between buying at $78 and buying at $76 is meaningless compared to the difference between buying now and buying at $110 after the next escalation. If you're looking at miners, quality is everything. Primary silver producers with all-in sustaining costs below $18 per ounce, and clean balance sheets will deliver 5x to 8x leverage on a move to $150. Byproduct producers will deliver 3x to 4x. Avoid high-cost, high-debt names that will get crushed if the dollar stays strong during any temporary de-escalation. The best names right now are those with proven management, operating mines in stable jurisdictions, and strong free cash flow generation even at current prices. This is not the time to chase the highest beta names. It is the time to own the companies that will still be producing when silver is at $60 or $150. If you are a paper trader or options player, the game has changed. The breakout above $82.50 with volume is your confirmation that the manipulation attempt failed. Until then, keep position sizes small and respect the invalidation level at $74.50. The next 7 to 14 days will be extremely volatile. Use defined risk strategies. Never risk more than 2% of your account on any single trade. And understand that when the COMEX finally faces a true delivery crisis, the gaps will be violent. You may not have time to adjust. Position size accordingly. The one price level that would make me go from bullish to extremely bullish within 48 hours is a decisive weekly close above $100 with expanding volume and a simultaneous expansion of the Shanghai Premium beyond 25%. That combination would signal that the paper market has lost control and the physical reality is now setting the price. At that point, the move to $130 and then $150 becomes the base case, not the aggressive case. This is the real warning, not the one you're hearing on mainstream financial media about geopolitical risk that will somehow resolve itself. The real warning is that the paper-silver system is running out of metal, out of time, and out of credibility. The COMEX registered inventory has fallen 68% in 6 years. The May delivery cycle is 7 business days away. The Shanghai Premium is already at 20.3%. And the world is on the brink of a conflict that will simultaneously destroy supply and explode monetary demand. The institutions showed you last night exactly how far they are willing to go to suppress the price one last time. They used a meaningless ceasefire extension to run stops and liquidate longs. They bought themselves a few more days. But they did not refill the vaults. They did not close the physical gap. And they did not change the mathematics that make $150 the logical destination if the war continues. The next 7 days will be the most important week in the silver market since January 2026. Watch the delivery notices, watch the Shanghai fix, watch the lease rates, and watch the COMEX coverage ratio. When any of these start flashing red, the move will already be underway. You now have the information. You now have the levels. You now have the roadmap. What you do with it is up to you. If you are still sitting on the sidelines waiting for the perfect entry, understand that last night at 75.65 was that entry. It lasted 90 minutes while most of the world was asleep. The next one will not come with a convenient headline. It will come when the COMEX runs out of metal and the paper price becomes completely irrelevant. At that point, the only price that matters is what you can actually pay to get real, allocated, vaulted silver in your hands. And based on Shanghai's $90.89 fix this morning, that price is already 15% higher than what the COMEX is telling you silver is worth. The war may stop. The war may expand. Either way, the structural bull case for silver at $150 remains intact. The only question is whether you are positioned when the paper market finally loses control. Drop your final thoughts in the comments right now. Are you adding on this dip? What is your target for silver if the war expands? What is the one thing you learned from this series that changed how you see the market? I read every single comment. If this series gave you clarity and conviction, hit like and subscribe. Turn on notifications so you do not miss the follow-up when we break $82.50. because that moment is coming faster than most people expect. The paper game is cracking, the physical reality is winning, and the countdown to $150 has already begun. Stay sharp, stay stacked. And never forget, in this market, the metal always has the final word.